So I'll touch on these key milestones so to have a better picture of what Koufu is, So we started in 2002 with our first food court. We commenced operations with 2 food courts and 1 coffee shop in 2002. And the first food court is actually located at HDB Hub. It's actually the first air-conditioned food court that HDB actually let out. So we are actually the so-called the pioneer pilot in trying out to run a food court. And since then, in 2003, we established our first central kitchen doing dim sum. So we provide we produce our own dim sum, and we actually distribute to our own food courts and coffee shops and our stores, dim sum stores within our own food courts and coffee shops. We don't really sell to third parties. And in 2004, we managed to tender for this operation of a commercial mall at Punggol Plaza. And it's our first commercial mall with HDB, whereby we are the master tenant. We rent the commercial mall from HDB, and we also sublet to 100 over retail tenants, including a food court that is run by Koufu as well. And in 2010, we managed to leapfrog, from the heartlands to high-end shopping mall food court at MBS. So we name it Rasapura Masters. Leapfrog because we all started from a Koufu brand, in the heartlands, everybody know us. But for a high-end, food court, a flagship food court in Marina Bay Sands, we have to really position ourselves very differently. And we have to show to the landlord that we can do a much better job and a different branding and strategy in terms of our food court operations. They do not want to see another heartland food court in MBS. So we managed to successfully tender for this food court at MBS, and they were really impressed. And with the successful venture into Rasapura Masters in Singapore, they also brought us along to Macau to set up our first food court in Cotai Sands. So in 2012. So this food court is not really a tendered out food court. So it's more like, the Sands Group, after knowing us that we can do a good job at Rasapura Masters, they also brought us along and asking us to partner with them to help them to manage and operate the food court in Cotai Sands. So that's how we venture to Macau. And in 2015, we started our first 2 full service restaurants under the Element brand. So to us, we were like thinking, our core business is always in the food court and coffee shop operations. But in order to go overseas and expand the brands easily, a food court may not be that easy, because after we have started the food court in Macau, we realized that, it's not all dependent on us. We have to set foot into a new country for many years, because we need to grow our tenant base, because we have to grow our tenant base, and we need to build out a strong management team in order to get into a new country. So for us, the thinking was that, if you can set up restaurants and even QSRs or even kiosks, that will be easier to replicate, and we can replicate it faster overseas. So that's the first time when we ventured into the restaurant, full service restaurant brand concept. And in 2018, of course, we were listed on the SGX main board. And also in the same year, we also successfully tendered for our first hospital food court at Sengkang General Hospital. And come 2019, we managed to find a JV partner in Indonesia to expand the brand of RMBT. And currently, we have already opened 2 outlets in Jakarta, and it is pretty well received, tapping on the successful opening of the MBS R&B tea. A lot of Indonesians come over to our MBS, and they have tried our tea, and they were really happy that Indonesia they are now open to the same brand. And I think 2020, which is this year, I think last month, 30th July, we have completed the acquisition of this fried food and dough products group, which is the Delhi Asia Group. I'll touch on this acquisition later. So for this acquisition of Delhi Asia, it comes with 4 entities. So Delhi Asia, Delhi Snacks, Dough Culture, and Dough Heritage, collectively they are known as the Delhi Asia Group. We have 2 brands. One is the Dough Culture brand, which is actually a retail brand, whereby there are currently 7 retail outlets in the shopping malls. And this is one brand which we felt has have very good potential to grow and expand. We are targeting to expand up to 20 and more within the next 5 years. We have already started to look for new locations to expand this brand. And under the other brand, which is the Delhi Snacks brand, it's actually a licensed brand logo, whereby there are 60 hawker stores that are using this brand. So we sell the dough products to these hawker stores, and they will just retail to their customers using our brand. So this is one area which we also felt that we can further expand on, because currently the DA group is, in the past they are quite so-called, they are not as proactive in terms of looking for new hawkers to grow the brand. So moving on, we felt that these 2 brands, we can actively work on expanding through retail outlets and hawker expansion. So other than that, we believe that the revenue it actually fast-track our revenue diversification, because they are also into third parties. They also sell to third parties, B2B customers. So we are able to gain access to new markets through the supply of such products. And we can also tap on these new market and expand our existing dim sum products that we were actually currently running at our own central kitchens. Other than expanding the 2 brands, we are also looking at overseas markets. Like we believe that these products can be exported overseas to supermarkets. So this can be a very big expansion and growth plans, which is newly added on to our one of our plans. So we see a lot of synergies in this new acquisition to our business. And in fact, this Delhi Asia Group is actually the one of the largest supplier of our Koufu fried food items, and we are in fact also one of their largest customer, selling to all our food courts and coffee shops. However, we don't carry the full range of the products, which we will continue to expand this range within our food courts, and even have new stores solely selling these products when we see a strategic location. And then that is one of the way to grow within our food courts. So we have different ways of expanding these products, overseas supermarkets, hawkers, through Dough Culture retail, and also through our own food courts store expansion. And also one of these, the good thing about this Delhi Asia Group would be that because we are also moving to our new integrated facility next year, and it's actually 5 times larger than our current existing central kitchens, and we wanted to do something more than what we have right now, and so this is actually a good integration. We'll also be combining the manufacturing, the production facilities in the new integrated facility next year. Okay, so in terms of the number of retail outlets that we have for 1H 2020, basically as compared to 2019, we have grown 2 new coffee shops and two self-operated F&B stores within the 2 new coffee shops that we have opened, and 1 F&B kiosk, which is an R&B tea. And other than that, the rest are all status quo. Because of COVID, we have not really expanded a lot in terms of retail outlets. So these are some of the outlets that have already been committed prior to COVID. So this is the in terms of our different spread for outlet and mall management. We have 48 food courts in Singapore, 2 in Macau, and then we have 18 coffee shops, one hawker center. I think this has to be updated also, because this is as at 30th June. We have since we returned the coffee shop hawker center to back to NEA, and one commercial mall. The F&B retail, we have 74 F&B stores in Singapore and 4 in Macau. So these F&B stores are actually located within the food courts and coffee shops that we are actually operating. And we have 7 QSRs under the brand of 1983 and Grove, and 4 full service restaurants, which is under the Element brand. We have like 28 F&B kiosks in Singapore, which is under the RMBT brand, and 1 in Macau and 1 in Malaysia. So you can see the various brands that we have for the food court segment, which is a multi-brand strategy that we are adopting. Okay, so these are the food courts that we have opened recently. I'll move on to the transformational strategies of Koufu. So we have 4 main strategies in terms of expansion plan. First one would be to continue to reinforce our foothold in Singapore, because our core business is in food courts and coffee shops, and it has been the contribution towards our stable and stable growth over the years. And it also provides us with a good fundamental and base for us to expand new brands. So we will continue to secure foothold in Singapore with new food courts and coffee shops, and also to expand more aggressively in the heartlands area, which we felt has lesser risk in terms of like times in COVID, right? The expansion within the heartlands food court give us more mitigation in terms of the impact. So this is one key area that we will continue to expand our food courts and coffee shops in Singapore. And the second area is in overseas. We will continue to expand in Macau first, because we already operated in Macau for the past eight years. Yeah, so we have got a strong management team there. We have good tenant base there. So we'll continue to build on that. We have opened a second food court last year, and the third food court will be open this year, I mean, as in this month. So the third strategy would be to increase the F&B retail segment, the recognition of the concept brands. So this is a very new area, because we were always in the food court and coffee shop segment. So a couple of years back, we started our RMBT, we started our Element, and we are also developing other brands like Dough Culture, the newly acquired brand, and also Grove. Grove is also a QSR, a meatless concept that we are self-developing. So these are some of the brands that we will continue to expand. The usual approach is to first try out the brand, and if it works, we expand within Singapore first to gain our market share and brand recognition. So thereafter, we will go overseas. So for expansion in Singapore, for the RMBT, we have expanded like 28 outlets so far for the past few years until now. And of course, there are new outlets to be opened in the later part of the year. And with that, we will also go overseas with these brands. Like in Indonesia, we have started two RMBT kiosks. And then in Philippines, we are also finalizing a master franchisee agreement. And that's for RMBT brand. And then for Element brand, because it's a full service restaurant, and we have 4 in Singapore. So the lookout for expansion overseas may be slowed down because of the COVID period, but we are still looking for partners and even interested parties to run restaurants overseas. And the other brand would be Dough Culture, which we have just newly acquired. There are 7 already right now, and we are targeting to expand 20 or more within the next couple of years. And this brand, which just now I mentioned, we are also trying to bring overseas, either through supermarket the products, or even such retail kiosks we can also expand overseas. But we will first establish the expansion within Singapore first. So this is the third strategy that we are currently executing. And the last would be the integrated facility. So this is actually a catalyst for growth in our opinion, because it's not just a cost center, an integrated facility to build up just for reducing costs, because we already have two existing central kitchens, which have more or less, assisted in cost reduction and managing it at a economies of scale level. So having an integrated facility, which is 5 times larger than our current size, at 20,000 square meter, we believe that we have to do a lot more than what we are currently doing, which is why we have also acquired the Delhi Asia Group. That can also, help to speed up the efficiency usage of this self-utilized area, which we have allocated about 70% of GFA for this dim sum bakery, as well as the Delhi Asia production of the fried dough products. And on top of it, we are also looking at new business opportunity like a cloud kitchen concept, which we are also planning to house within this integrated facility. And other than that, this integrated facility is actually constructed in a sense like it's just like a food factory that a JTC built. There are ramp up car parks, whereby a 40-footer container can go in. We have actually allocated, like 20 units of the spaces to be rented out to store tenants or even to F&B players who require a place. It is very strategically located at the, just after the exit of Woodlands Avenue 12. SLE Woodlands Avenue 12 is located pretty near to the MRT, Woodlands South MRT, which is in future going to be connected to Malaysia, JB. And this is also, the location of this integrated facility is also just next to the Woodlands Hospital, which is under construction right now. So it's very strategic, and we believe the demand, this can actually drive demand, which we have already started to market out the units for rent. So what I'm trying to say is that we have built this integrated facility such that it can be rental deriving, and we will also generate new business from this new integrated facility. So we're not depending on our current existing business to be housed in this new IF. This can actually, and also one thing to note is that this integrated facility has really low cost of operations. We actually rented this land, or how to say, it was allocated to us through JTC at a really low cost of land premium of 3.9 million, which is actually for a 30 years lease. So instead of buying from the secondary market to tear down a building and rebuild, we got it at 3.9 million for 30 years lease, and then we just need to construct it. Yeah, so the cost of it is already pretty low. If you calculate at 40 million of total construction cost, is over 30 years is nearly about $1 million of depreciation. And we believe that with the rental income and the cloud kitchen, as well as the new business that we have brought in, will be more than sufficient to drive profitability for this. So we are looking at this integrated facility as a new profit center. So it's targeted to complete construction by hopefully Q4 2020. We are keeping our fingers crossed. Hopefully it can be completed then, and then Q1 we can actually move over. So productivity has always in our bloodline. For Koufu, we have actually started on this productivity journey way back in 2009, 20 years ago. I think more than 10 years ago, where Singapore actually emphasized on improving productivity. So since then, we have actually looked at different areas of productivity improvements, including management systems, how to improve on the process systems within the management system, and also we have moved on to the front-facing servicing part, which is like the tray return robots. We have actually implemented 43 of such smart tray return robots to help our cleaners in terms of collections of the soiled dishes and things like that. So it can actually move on to the dishwashing area on its own after it's full, it's detected full, and then it will move back, thereafter, and then continue to be, for self tray return purposes. And other than that, the unified payment terminals, the next unified payment terminals. So what we're trying to say here is that it's actually a terminal that accepts different kind of cards. In Singapore we have EasyLink, we have Nets, then we have credit card, Master, PayWave. So there are different kinds of terminals for different purposes, different cards. And then we were actually the first one to implement this Nets unified payment, because we asked them to work with us to consolidate all the different platforms together within one Nets unified payment terminals. Within our one food court, we can have 20 or 25 stores. Having one unified payment terminal at each store, it actually helps to improve productivity a lot, instead of having 5 or 6 different terminals. So this is one area that we have been driving productivity through. And the mobile ordering application, which has been implemented at 42 food courts and coffee shops, in order to encourage self-ordering payment and collection, we also give customers a 10% direct discount on that. We have also, during the circuit COVID period, the circuit breaker period, rolled out the delivery option, whereby you can order and then we can also deliver to your household. And the other one would be the traditional coffee making machine. We have started the first pilot outlet mid last year. We are still looking at fine-tuning this machine, or even we have also started trying out other machines at the same time. They are also available in the markets, other machines. So we hope to implement some of these machines to good use, in the near term, in order to speed up some of the coffee making process, as well as consistency in that. So in terms of improving productivity, we will continue to embark on this journey, because we believe that it's actually a key enabler, especially for F&B services, whereby we are always short of manpower. Productivity improvement is definitely one key area whereby it can help us to generate value creation. So this is almost that. And last of all, I think let me touch on some investment merits on Koufu. We are actually one of the Singapore's most established and largest operators and managers of food courts and coffee shops, with a presence in Macau. And we have complementary business segments with diversified revenue stream. So both the outlet and mall management segment and the F&B retail business segment complements each other. And because food court is actually a very, everybody needs to eat, then it's also serving the mass market. So we believe that we are very resilient and we have steady income stream. And we believe in a strong quality store operators and active manager and operator partnership. So we manage and we help our store tenants, in achieving better sales, and thereby providing us with better returns. And in terms of the supply chain, we also believe that we have a comprehensive supply chain system, and it actually facilitates our cost management and also operational efficiency. And besides that, the number 6 one would be to using productivity as an improving productivity as a key enabler for, and using technology would be one of the areas on how we improve productivity, besides training and other systems that we have put in place. So last but not least, we are an experienced management team with a proven track record, and we also have committed to dividend yield for the last 2 years at least 50% of the NPAT. And this has always been a discipline, although it's not a policy, but we have always been doing that even before we were listed. So a very disciplined approach of giving back to the shareholders. So this is something that we have also been embarking on, and we'll hopefully continue to do so as much as possible. Yeah, so I think that's the end of my presentation. I'll pass back to Terence.
Thanks, Charlene, for this presentation. Just a reminder to all participants that if you have any questions, you can ask them through the chat section. I can already see that we have some questions, so please keep them coming. So before that, maybe I'll start with two questions first, Shirley, from your presentation. Yeah. So my first question is for your F&B retail segment, which was hardest hit in the first half 2020, and also the outlet management. How much have you noticed takings improve in phase 2 of the circuit breaker?
Okay. In phase 1 and circuit breaker period, I think same store sales went up by almost 40%. So subsequent to that, in phase 2 of the economy reopen, it has actually jumped double fold. I think the drop is now 20% instead of 40. So it's improved quite a fair bit lah. And we are looking at gradual improvement further over the months ahead.
Yeah.
F&B
Great. The second question is, you recently made an acquisition of Delhi Asia, which you shared during your presentation. I was wondering if you can also elaborate on Koufu and the management, how they think about the M&A strategies of the group.
So for us, we have seen a lot of opportunities like on M&A being flagged out to us on and off. But for us, we believe that we want to ensure that there are synergies in terms of the acquisition. So first thing, we look at this Delhi Asia Group. We felt that there are a lot of synergies. Firstly, they are also in the mass market, which is same as us. So we are very we are happy to look at mass market kind of business. So this is something that we are looking at, and also this is something that we are also the products we have also been retailing through the Koufu food courts, and we are also, I mean, we felt that this has a lot of room to grow because in the mass market, and they are also dealing with hawker centers, so during this COVID period, the mass market are the less hit segment. So to speak, because this acquisition is actually made, the decision to acquire is actually made, during or even straight during this COVID period. So we have also seen through the resiliency of this business. So we felt that, in order to have acquisition, there are a lot of opportunities out there that, there are restaurants, there are factories, there are even a lot of other chain suppliers that have out to us. But what is important is what can we do out of it. So we saw that, for this Delhi Asia, there are a lot of things that we can do. The dough culture retail, we can even expand the hawker stores sales. And we also thought that actually we may also be able to retail our dim sum through the hawkers using a licensed brand, So it actually gave us a lot of new ideas on, we can learn how they do it, and then we can also do it. So the M&A strategy is not one that, it's not something that we think that we can have every now and then. It must really fit our business and our growth plans. So it's not one that come by very easily.
Maybe just one last follow-up question on that. You have plans to move the Delhi Asia, their current operating premises, to your integrated facility when it's done. So just wondering if you're able to share when their rental lease of their 2 premises is expiring.
Quite soon. I think one is next year, one is the year after next.
Okay, so
I think we won't wait till then. We will just move over because we are already planning the space.
Okay, sure.
So we will talk to them to pre-term or what.
Okay, sure. Okay, so we'll probably just move on straight to the Q&A questions. We have a few, so I'll just start, and then you answer them. Okay, so the first question is from the floor is, how much negotiating power do you have on more owners, or if you vacate there, will there be ready tenants to take over? So I guess the question is how much negotiating power you have on more owners in terms of lease.
Okay. So for we are in both heartlands and the commercial mall. So majority we are with HDB. So I have to say that HDB, as HDB landlord, I mean tenants of HDB, right? HDB don't really change tenants any other day, So So the first right is usually to the existing tenant, and it's more to a rental negotiation process lah. So long as you go in, so that's also why the reason why we also tender for HDB, it can be like 3 or 4 years ahead before the population actually moves in. Because once you're in there, right, you'll most likely be there forever. That's what I'm trying to say. So as compared to commercial mall owners, right, we don't see commercial mall owners changing operators, every 3 or even 6 years or so. Being, food court operators are still food court operators. It's actually um, it's actually the footfalls of the commercial that you are attracting to the food courts So to say that if let's say there's this rental negotiation process going on, and then if we do not agree to such rental rate, will they just tender out to someone else who is willing to pay a higher rent than us? Most likely not, because food court operators, there are not many of us, and we know that if this person cannot operate at this rental rate, I don't think anybody can go in and operate at a higher rate. That would be suicidal. And also for landlord to change a tenant, right? They will usually have to, give time for reinstatement and then renovation again. And then this downtime of at least 4 months would be a total rental loss to the entire lease term of only 3 years. So to them, I think they will also look at the incremental in terms of lease versus the downtime. 4 months without rent, you have to give rent free to the new tenant that is taking over. So far, we have not really seen a lot of such cases. So it's always the case whereby, let's say we decide to move out, we terminate, because this place is not making money and we are not able to push the rent down further. And the landlord will usually take back and then carve out into smaller units, and then to rent out to smaller units tenants whereby they can actually get a higher rent. Do so. So this is like the case.
Okay. The next question we have is, are food courts a lucrative model or HDB coffee shops? I guess the question is more on the margins.
Okay, I would say that I think prior to COVID, right, we can see that food court versus coffee shops. Obviously, food court has a better model because there is a variable rent component for this food court business to you have the opportunity to get better rents lah. Whereas for a coffee shop, right, it's basically fixed rent. But during the COVID period, we realized that coffee shops are not that badly hit as compared to food courts. But however, the HDB food courts are still okay. Commercial food courts are more badly hit. Because people start to avoid going to commercial mall. There are so many, safe distancing measures. You have to scan your QR code and things like that. So it becomes a mall, So I think at different times, food court, we still prefer food court because there's an upside to it. Yeah, a coffee shop is actually very risk-free.
More troublesome also at the malls. Okay, question. How was your sales and profit for the months of June and July? Yeah, so I guess that's more related to these two ones that you talked about. So we probably move from this question.
I think for June, because it's included in the 1H 2020, I can say that after 19th of June, it has really picked up. Just like I mentioned, like double fold from a drop of maybe 40%, same store only dropped by 20%. And then come to July and August, I think it's improving. It's improving further.
Next question, what's the plan for the old facility after the TOP and completion of the new integrated facility in Q4 2020? Divest for special dividends? What's the contribution of the Koufu delivery app to the bottom line currently? So that's, I think, 3 questions really.
Okay. I'll go to the first question first. So the existing 2 units, right, we are looking at selling off because that's also one of the requirement of JTC when they allocate the new land to us. We're supposed to sell off. So we can actually sell off to the secondary market, and we are looking for buyers right now. So, obviously the profit that we gain, will be distributed for special dividend. That is something that we have agreed to, because this is on top of our ordinary business profits. Yeah, this is definitely one area that we will look into. But as to how to give up, whether one shot or distribute over a couple of years, this is something that we need approval lah. Yeah, so the contribution of the Koufu delivery app to the bottom line is not very high, I have to say. Because the delivery option is also is made available, especially during the COVID period where people tend not to go out, to take away or even you can't dine in anyway. But because food courts and coffee shops in Singapore they're so nearby each other, you can literally go down to a nearby coffee shop to buy your takeaway food, that you can save on the delivery cost. So although we have launched this app application, the contribution is not high, I have to say. It doesn't really help a lot. Yeah.
Yeah, and it's also only in certain areas at this moment, right?
Yeah, only 2 areas are available right now, but we're trying to expand to the entire Singapore over time.
So next question is, what is the expected contribution from Delhi Asia in terms of top and bottom line?
In terms of Delhi Asia, last year, FY 2019, the profit is about 2.4 million. And then in terms of the revenue, it's about 13 million. So we are expecting at least that to move in. And obviously the anything above and over would be what we are creating in terms of. So at least these two amounts should still be there, contributing to us.
Okay. Next question we have, what is the revenue model for your local and overseas outlets? Is it purely rental dependent or include a percentage of sales?
So for both local and overseas food courts, right, they are on the base rent and a higher of gross turnover sales. So in local and overseas, they are all the same. So the only difference is coffee shops and food courts is different. Coffee shop is just on a base rent. Yeah, so both local and overseas food courts are the same.
Yeah. And I think we have one question also on your digital transformation presentation earlier on. Any plans for digital transformation, such as increased automation functions, online platforms, etc., to increase reach?
So, I also shared that, during this period, we have actually rolled out the delivery function of the Koufu mobile app. So this application was already there, but the usage was pretty low, and it's only limited to the takeaway portion. But post-COVID, even in phase 2, we have seen an increase over pre-COVID in terms of the mobile app ordering application, be it takeaway or delivery option. I mean, although it's not better than COVID period, but it's still better to pre-COVID levels. So we will continue to put in more resources and to try to improve this portion of the Koufu mobile ordering application to increase our customer reach.
Next question we have, what is the remaining amount of capex to be paid for the integrated facility, and is there any possibility that the 30% cap on your GFA to be rented out be lifted?
The remaining amount of capex is roughly about 10, 20, 50 million, I think, if I'm not wrong. About 50 million to be paid. So if we add in the renovation costs and other equipment that we need to purchase, is about 20 million that we need to put in for the integrated facility. Is there a possibility that the 30% cap to be rented out be lifted? I'm not sure whether you're referring to because this 30% cap is actually a JTC requirement on us that we can only rent up to 30% from 5 years onwards. But within the first 3 years, I think we can rent up to 50%. So this cap is there to help us to slowly, at least we can rent out part of the portion of the GFA and not weighing the entire cost on us. So we don't think that this needs to be lifted in any way. We are already looking at how to, to ensure that these units that have already been carved out, can be fully tenanted out. So we are working on tenanting out these units.
Next question we have, with the integrated, I think this is on your gearing facility at 40 million and acquisition of Delhi Group at 22 million. Will this affect the gearing of Koufu?
Okay. Okay, I think we are cash rich, as in we have sufficient cash, and also during the IPO, the proceeds were actually to be utilized on the integrated facility, and also is already for this purpose. And part of the acquisition cost, 5 million, is also coming out from the IPO proceeds lah. So the balance is all from our internal cash. So we don't think it will affect gearing. Yeah.
Okay. We're actually running short, a little bit short on time, so we'll go through some of the questions a bit quicker. So what are the questions? What are the revenue opportunities from the integrated facility?
Okay, so just now, like what I mentioned, rental income is definitely one part of it. And then the existing existing central kitchens from the bakery and the dim sum. We're looking at dim sum to sell to external parties, third party markets, which is something that we are not currently doing. And also the dough culture to expand beyond the existing, production level, even exporting overseas. So these are some key areas.
Okay. What was the reason for accounts receivable to rise to 23 million from 10 million at end December?
Yeah. I think there's this deferred rental rebate that we have. So what happened is the accounting treatment of the rebate to our store tenants will not be recognized in the month that we have given to them. So it will be deferred and recognized over through the balance of the lease term. Yeah.
One question here, I think, what is Macau's contribution to revenue?
Okay, just now I think it's about 6%.
Dropped from 9.
Yeah, from the previous 9.
One question for the participants is, what is Koufu's growth strategy?
I think I've touched on that in my slides, the 4 main strategies.
Yeah. So one question on the capacity cuts. How much capacity in the food courts have been cut?
Capacity, yeah. I think about 10%, about 10% has been cut.
Okay. Because of time, I think I'll probably choose another 3 questions, so that we don't hold up. I think both your operating and admin costs of 2020 second half should increase compared to 2019 second half. Can you share your measures taken in lowering your costs, and what is your contingency plan forward should the pandemic prolong indefinitely?
The operating expenses showed an increase because of the impairment of the PPE and the ROU we have I have just shared 1.5 million. There's actually a one-off impairment expenses being charged, especially during this COVID period. We're very conservative that anything that may affect, we will just front load it right from the start. And I think for the administrative expenses is maintaining at the current level of last year. So I wouldn't think that it has increased by a lot. But I think we have a lot of variable components of the business that, like just now when I mentioned COVID, we reduce on the cleaning expenses. We also, our staff cost is like 30 over to 40% is actually a variable cost linked to the performance of outlets. So when outlet sales reduce, the variable incentives and performances bonuses will also be reduced. So these are some of the areas that we can control, and there are other things that we can't do much like depreciation. Property rentals, a certain proportion of it is linked to footfall, GTO. So property rentals, certain part can also be reduced. So I think during this period, we have taken all that we can to try to reduce as much as possible our costs, and also to pass on some costs to our store tenants.
Okay, so we have one dividend question also. with net cash of 72 million, will there be chance of increased dividend payout as current yield is only 3%?
Okay, I think this 72 million is prior to the acquisition of the Dough Culture lah. So after the Delhi Asia Group, 22 million has been taken out. It's a balance of 50 million. And we have also learned through the years that, we have a very disciplined approach of paying dividends of 50%, so that in bad times like these, we still have sufficient cash to tie through. If not, I don't know how we are going to fork out the money to tie through this period also. And also in good times, we don't really have the practice to pay out a lot more unless we don't have growth strategies in place, because we still have a lot of growth strategies in place that are new capex that needs to be put in. We can only look at special dividend, when there's a special, like a sale of the existing country kitchens. That's my reply.
So there's another a bit long-term question. What is the targeted mix for revenue derived from Singapore and overseas in the next 5 to 10 years?
For overseas and Singapore, we used to be at only about 9% for Macau versus 81, 91% for Singapore. So we are actually looking at 15 to 20% for at least 5 to 10 years now. Because the base is pretty huge right now.
Okay, so maybe just one last question to end.
Yes.
Okay, so we have one question on the expected NOPAT margin. So one of the question is, what will be the expected NOPAT margin with the completion of the new integrated facility? So that's 2021.
That one a bit tough to say right now because of COVID the NOPAT margin has gone down by quite a fair bit. But looking at just pre-COVID levels, we used to be at NPAT margin of 11 to 12% in the past. So with the new integrated facility, we think that it will somehow help in terms of at least maybe 2 to 3% upwards lah. Yeah, in terms of economies of scale as well as the rental deriving portion of it.
Okay, thanks so much, Shirley. Thanks for your presentation, and thanks for everyone for joining us today. We can't answer all the questions, but please feel free to reach out if you have any questions, and then we'll direct them to management if we can. So thanks, Shirley, for joining us today. And
thank you, Darren. Thank you. Bye bye. Thank you, everyone.